Welcome to the Akshar Group. In this video, all the information about trade credit insurance is given. This includes important information related to insurance like benefits available, feedback, enrollment feedback, as well as the process to contact our office. The terms and conditions of the policy are included. Read it carefully. Let us further know what is trade credit insurance. Trade credit insurance is a type of business insurance designed to protect account receivables of a firm which may get impacted due to non-payment or defaults by the debtors or buyers. One such reason for buyers making defaults in payments are commercial risk, protracted default plus insolvency, or political risk. Such risks may be beyond the control of businesses or individuals. However, protecting the business from risks such as non-payment, delay in payment, unknown buyer, or unknown geographies are vital to expanding the business. Many national and private insurance companies in India offer trade credit insurance. It helps business owners recover from losses due to customer defaults and, in turn, increases business profits, improves cash flow, increases sales, and reduces unexpected customer bankruptcy risks. It also protects the exporters from any loss incurred due to political event happening in the buyer's country because of which buyer is unable to make payment to seller. Why should you buy trade credit insurance? As a result of globalization, business opportunities have increased and companies are facing increasingly complex requirements in terms of trade receivables management. Trade credit insurance is a tool that helps companies expand businesses with peace of mind. Trade credit protects insurance companies from defaults by customers. It covers the sales of companies on credit to its buyers against the risk of loss due to non-payment, bankruptcy, and political risk. Credit insurance plays an important role in the business cycle of any company by protecting the profit, cash flow, sales growth, balance sheet, and customer base of the company. It can greatly help in the growth of sales by allowing safe growth of new buyers, new markets, and credit given to the buyer. What are trade credit insurance covers? Trade credit insurance covers two types of risks: commercial and political risks. Commercial risk, insolvency or bankruptcy of the buyer. Protracted default, willful default or non-payment by buyer. Political risk, general moratorium upon payment by the government of the buyer's country, cancellation of import license, political events, economic difficulties, legislative or administrative measures preventing payments, military, revolution, riot or rebellion, non-payment by government buyer, government's decision to stop the demonstration. How does trade credit insurance work? Let us understand how trade credit insurance works so that you can get timely benefits when needed. The biggest setback in the functioning of any business, be it small, medium or large, is the financial loss which can happen due to various reasons. There may be times when you have sold a product or service to a customer or group of customers and unfortunately the payment gets stuck. If this amount becomes large, it can also lead to the closure of the business. A trade credit insurance helps in managing such situations by providing the unpaid amount by the customer. This payment is made in a fixed percentage and not 75 to 100% of it, as should be pre-specified in the policy document. Guidelines: Trade credit insurance. New trade credit guidelines allow licensed banks and financial institutions to buy credit insurance policy. This change will facilitate banks and financial institutions to mitigate country risk, open up access to new markets, and manage non-payment risk associated with trade financing portfolio. Micro and small enterprises can now buy a trade credit policy to cover a single buyer. This will enable general insurance companies to offer single buyer credit insurance cover to SMEs and MSMEs, considering the evolving risk needs of these sectors. Revised indemnity for trade credit insurance. A trade credit policy shall specify the indemnity limit being offered, and the maximum limit that may be offered shall be clearly indicated in the product filled with the authority. IRDAI allows covers for projects with tenure of more than 6 months. The scope of the cover has been widened to include projects with tenure exceeding 6 months under the policy. IRDAI allows coverage for rejection of material in case of goods customized to a buyer. Coverage can be extended for non-payment risk due to rejection by the buyer before shipment where the goods are manufactured or being manufactured exclusively as per the requirements of the buyer and cannot be sold elsewhere. The buyer after delivery subject to continuance of the contract. Eligibility criteria. Any company that has receivables on its balance sheet is likely to suffer losses from a customer's inability or failure to pay. Such companies can enroll for a trade credit insurance policy. Exclusions under credit insurance. Not all situations are covered by credit insurance, also known as exclusion. Any problems caused to the business due to the following reasons are not included. No nuclear exposure due to radioactive substances. Customer dispute with the buyer which may result in withholding of payment in full or in part by the buyer. Any interest amount that occurs after the original due payment date. Amount outstanding by any government entity which cannot be declared insolvent. Currency volatility. Reverse factoring policies. Pre-shipment risk. Turnover declaration. Within 15 days from the end of quarterly reporting period of gross invoice value of eligible shipment to which it relates. Stop shipment. You must stop all shipments or sales to that particular buyer that have been due for more than 60 days. You will report monthly to the insurer for accounts receivable for any buyer that exceeds 30 days due. You shall report to the insurer at least 15 days prior to the expiry of the policy. All accounts receivable for the insured of the buyer under the policy. Trade credit insurance claim process. Many national and private insurance companies in India offer trade credit insurance policies in India. However, internal systems and processes may be different for different companies. Let us look at some general guidelines regarding the processing or settlement of claims in India. Must submit written proof of damages within 12 months after the end of the waiting period or within 30 days as requested by the insurance company. Usually in case of bankruptcy of the buyer. Documentation required at the time of claim. Duly signed and stamped notification of overdue account or claim form. Clear and legible invoice copies. Statement of account, NOA and SOA dates must be the same. Balance confirmation. Proof of delivery. Purchase order. Sales contract. Debit or credit note copies if there are any. Copy of communication with the debtor following up for payment. Any other document as specified by the insurers. Note, all the above documents are not mandatory and can be discussed on cases-to-case basis. If you have any questions or need any additional information, the team letters will be happy to assist you with all matters related to your insurance benefits. To know more about this scheme or to buy it, please contact Akshar Group. Please do not delay in taking this decision. Contact us today. Thank you.